Welcome everybody who is filing on in here. We'll take just a few minutes to let everybody uh, get welcomed in here to the last Community Capital Live of 2024, I realize. And since it is, I don't know if it might be fun for us to just, for Kevin and Michael especially, for maybe those three of us to just kind of reflect a little bit that this, what the intention of this was, is we were really looking, I know the two of you were really looking to expand the ease of access to information around local investing and around impact investing for ordinary people. And I'm really happy with and really grateful for getting to just kind of come along for the ride with you guys here on that, because I really do think that that is what we're growing into. And I'm excited to see where it goes in 2025 and what we're able to do. For those of you that are new, this is a partnership between a few different entities. One of them being Impact Alpha, which we oftentimes refer to as the Wall Street Journal of Impact Investing. Definitely a place you should go if you're interested in any type of impact investing to get updates and news. We are working with them on a database for this information and getting this podcast up on their site in the coming year. The other groups that I want to make sure we mention are Neighborhood Economics, which is a conference series that convenes impact investors, local movers and shakers like community organizers, nonprofit groups, and entrepreneurs, social entrepreneurs, and entrepreneurs who come from redlined communities and communities who have been disenfranchised. So definitely check out Neighborhood Economics. I got to go to the one in San Antonio this year, and it was just really, really a great time. And I learned a whole lot of good stuff and met some really meaningful connections there too. So check out Neighborhood Economics. We'll also want to definitely mention the Main Street Journal. That is your Wall Street Journal for local investing on your Main Street. That's actually what brought me to all this, was my interest in the ability that a normal person could put their money into a local business rather than into Wall Street. And if you're interested in that, Michael Schuman and the Main Street Journal are the best place to start. So check out the Main Street Journal as well. And I host a radio show on Biz Radio US called The Mindful Marketplace about social enterprise, about community investing, and ownership models of democratically owned businesses. So really glad to get to partner with all of you. Today we are talking with Kathleen Paylor, who is joining us from the Regenerative Social Fund. Kathleen, so good to have you on today.
Thank you. Glad to be here.
Yeah.
Thank you. It's RSF Regenerative Social Finance, just for clarification.
Okay, yeah, my mistake there. Regenerative Social Finance. So tell us a little bit about RSF and kind of what was the I guess what was the soil, what was the groundwork that kind of led to the creation of RSF when you all first started?
Yeah, I mean, when we started was 1984. So we were really the OG of impact investing. And we really started around the Waldorf School and really being something of a bank for Waldorf schools who were finding that it was hard to get mortgages and things like that. And there was a group of folks who were aligned with Rudolf Steiner and his work, who wanted to have an impact first bank to enable the Waldorf schools to have aligned capital that would enable them to purchase the schools or to get mortgages on the schools. So it was really about being able to provide loans for Waldorf schools. Obviously, we've come a long way. This is our 40th anniversary this year, and we've expanded vastly since then, both in terms of portfolio size and in terms of what we do. I feel like I'm getting a little echo there. But yeah, that was the substance of and early days of what we did was a history around Waldorf School and Rudolf Steiner. In fact, our name, we've had a few iterations of our name, but originally we were the Rudolf Steiner Foundation. Then we became RSF Social Finance, and we formally changed our name to RSF, regenerative social finance, a few months ago.
Yeah, that's fantastic. So when did you get involved, and tell us a little bit about the work you've been doing?
So I've been in RSF's ecosystem for a long time with my own work, with a firm that I had called Conscious Capital. But I've been at RSF formally as a staff member for the past year and a half as the VP of Impact Investing, and Philanthropy. And really, like I'll just dig into like what we're doing now at a micro level. The main problem that we're solving for is access to capital. We work with entrepreneurs who would not readily have access to capital, or at least to non-extractive capital, and who want an aligned partner who isn't just going to write them a check and wait for the payment, but to partner with them in what they know will be, and what we know will be a up and down journey. And then at the macro level, what we're solving for is a broken financial system. Our new mission is to change finance and finance change. And we know, everyone on this call knows, that we're operating in an extractive and broken financial system that values, the highest returns and the highest profit above all else. And the consequences for that, as we were talking about before the call started with Kevin, and thinking about the what's just happened in North Carolina with Helene, the consequences of that are now coming full circle, and we're paying for them. So the work that we're doing is to demonstrate that finance can be done differently, with great success and with some profit, but with really returns that I like to call regenerative, because they address the whole circle of return on investment, not just the capital part of it.
Yeah, I want to let Michael and Kevin here especially dig in with you on how you guys are financing change. But I'm curious, on the side of changing finance, what do you feel like is the biggest one or two things that would really move the needle the most?
I mean, I think the things that tend to move the needle most are demonstrating success and also demonstrating consequences. And I think we are seeing consequences now, for sure, of looking at one metric above all else. And I think we can demonstrate success in some of the things that we are doing, and so many other people now. When we started in 1984, there was no such thing as impact investing. Kevin, when I went to the very first SOCAP, you didn't even know if the place would fill up. And now, many years later, many decades later from our founding, a lot of other folks are working at this. And I think along the spectrum of returns, from pure capital preservation to market rates and beyond, folks are having impact in different ways, and showing that you can care for people, planet, and make a profit at the same time. And so that, to me, is the massive demonstration project of impact investing that's happening right now.
Yeah, I love you guys demonstrating that possibility. Yeah, I'd love to throw it to either Michael or Kevin, whoever wants to kick us off on the next set of questions here.
Well, let's start with some numbers. How big is the fund now? How many entities are you giving loans to? How many people are putting money inside the fund, and where are they?
Yeah. So the fund now is about, by the end of the year, it'll be at about 140 million, which, as funds go, is, super small. But I like to think of us as at least trying to be a trim tab and have that size, have an outsized impact. Our number of borrowers, I want to say, is around 60, but I think I have somebody on the call that can correct me if I'm wrong. And they're all over the United States. We have a slight concentration in California and on the coasts, California, New York, but we're all over, but almost entirely in the United States. And then from a sector concentration, our focus areas are food and ag, and by ag being regenerative agriculture, and then food, sort of products and things like rice or spices and things like that. Education, that's still a core component of our investing, though it's not the focus now. A lot of what's in our education portfolio is historical. And then climate and energy, and community impact, which contains a variety of different kinds of things like arts.
So the last time I looked deeply at your fund was when I wrote a book chapter about it almost 15 years ago. And at that time, you were doing filings in 40-something states to allow grassroots investors to participate. The money from those investors would then come into the fund, and then the fund would reciprocate and put the money out in the community. So is that still largely what the structure is?
Yeah, that's 100% the structure. So that's 100% the structure with some key changes. So for 39 years, we had one product. So we sell notes. That is our core business. We sell notes to aligned investors that the funds from those notes go to fund impact first social entrepreneurs. For 39 years, we had 90-day notes, and only 90-day notes that hovered in the 1% on the rate of return for investors, went as low at one point as 0.25%. And we set those quarterly in response to micro and macro trends. A year and a half ago, we decided, for reasons both external and internal, to introduce 3 different duration and return notes. So we now have a 1-year, a 2-year, and a 3-year note. Well, actually, let me rewind that. We are going to remove the 2-year note. So as starting in February, we'll just be offering a 1-year note at 2% and a 3-year note at 3.5%. And the minimum investment, to get back to your question, the minimum investment for the quarterly notes are $1,000, and then for the longer term, longer duration, higher rate notes is $25,000.
Okay. And one other feature that I just, it's always been I thought a remarkably innovative piece is you're having groupings come together of investors and businesses to decide on the appropriate interest rate. And maybe you could just talk a little bit around the philosophy of that and what that looks like now.
Yeah, that's a great question. That is one of the ways that I came to RSF, was around pricing gatherings, which is what you're talking about. And this was a practice that RSF instituted decades ago to bring together borrowers and investors to be in community and conversation and talk about what makes sense as an interest rate. And often what that looked like was a borrower might come thinking that they need a point or a half a point off of their rate, and an investor might come thinking they sure would like another point or two in returns. And then they sit down together and talk about that. And when they actually are looking into each other's eyes, and an investor sees that farmer, and that farmer meets that financier, or whoever it is, they understand that there's a human on the other side of an interest rate, which is, to me, one of the things that I think we've lost the most, that there is someone or something, some other entity, whether that's planet or non-human animals, on the other side of an interest rate, that there are always consequences to things. And that relationality was a core part and remains a core part of what RSF is and wants to be, and part of what attracted me to our work. And so in that conversation, which was not by any means the only factor that determined, just because a borrower said, I want more, an investor said, a borrower said, I want less, and our investor said, I want more, we wouldn't change the interest rate. But it was an opportunity to, what I call, humanize finance, and to see the other person and to understand their needs. And what often, if not always, happened in those gatherings is that both sides would say, I don't really need that half a point. It's okay. I didn't realize, the investor might say, that would have such an impact on you as a struggling regenerative farmer. So let's actually move it down. I don't really need it. So things have evolved, particularly with COVID. And we stopped doing the pricing gatherings in person. We started doing them online. And what we have found is that sort of post-pandemic, fewer and fewer folks came, particularly on the investor side. And so right now we're sort of in a liminal space with like, what do we want and need? And what does our community want and need those gatherings to look like? And so we've got my marketing and communications guy, I think, is on this call, but could speak to that. But we're redesigning it. So I think the sort of high water mark or North Star around that is, how can we humanize the work that we do? How can we bring both sides, the capital in and the capital outside, together and sit in circle, if only sort of theoretical, and talk about what the impact is we're having when our capital comes together with our capital, when our capital and our intent and our impact come together. What can we do? And also to understand the needs of both sides.
Let me just ask one more question, then I'll pass it on to Kevin. And that is, you said that you have 60 borrowers, a fund of 140 million. How many investors do you have, and what do you know about them, their demographics?
Yeah, it's a super interesting demographic for our borrowers. So about 60% of our fund is made up of quarterly notes. So it's 1,300 investors, roughly, give or take, 1,300. A lot of the way that the loans would happen in the early days was that we would make a loan to a Waldorf school, and then they would invite their teachers and their community to then invest in RSF, which is where the $1,000 level partly came in. So a lot of those, it's quite interesting when you look at sort of an asset allocation or a kind of picture. We have long-term capital out, and a lot of these, these are very short-term notes. These are quarterly notes. Nobody has a quarterly note. But in fact, the quarterly notes have become very long-term capital. A huge percentage of those funds, still, again, roughly 60%, have been in the fund for over 10 years. So they've really, what I like to say, just sort of set it and forget it. So, and because we've only had the new longer term notes for a year and a half, and have sort of slowly been introducing those into the market, the fund is largely made up of the 90-day note holders that have the opportunity to invest for $1,000 or more. So we have a lot of, little balances, and then a lot of, some multi-million-dollar balances as well.
Right, great. Kevin, over to you.
And just really quickly, those 90-day notes, they don't get their cash back in 90. They typically are just rolling it over.
They are,
right?
they have the opportunity to, absolutely. But yeah, no,
Right.
that's what I was saying, is they tend to not. And obviously those
Right.
folks were not, they weren't coming in for the return rate to begin with. So they're really not out shopping for the highest rate of return.
They're thinking of themselves as a philanthropic investor, really, that there's a gift along with, they're giving back.
I think that's right. And yeah, I think that's right. And I think there are a lot of those early investors who were so aligned with the deep beliefs around money as energy, that money can heal instead of harm, are so aligned with RSF that they couldn't find. They're not just about impact investing, because that's not how this started, and there wasn't such a thing. They're really aligned with the belief that money can do more than what it's currently doing, and not just be neutral, but that it can actually heal. So the value for them of being invested with RSF is kind of, as MasterCard would say, priceless.
So I'm in the epicenter of Hurricane Helene, Swannanoa, North Carolina. The river ran through our house for 6 hours. I'm in an Airbnb that we happen to own, but we're doing so many more things that are related to relief that I've never had to deal with, because I've never been in a disaster before. I mean, our neighborhood no longer has a grocery store a post office, a hardware store, any restaurants, you just name it, you know. And so I'm working with a network of urban gardens called the Bountiful Cities in Asheville. And we're looking at a project that has three elements. It's climate resilience, food security, and reparation. So we're working in the 6 neighborhoods that were urban renewaled here, that were suffered redlining, et cetera. And so, but there are community gardens there. And so we're creating a philanthropic investing. We're actually on the Impact Assets catalyze platform for grassroots philanthropic investing. But we've got a big donor who can seed the project with $500,000. And she's one of these great new DAF investors who are willing to seed something, be exceptionally patient, and then want to see community come on board to take it further, right? And so what we're doing is hydroponics in each of the 6 urban renewal neighborhoods. So there's food security, but there's also climate resilience, because, you know, our grocery store is still not here, right? So I mean, climate resilience, you know, we're 10 miles from a grocery store, and a lot of neighborhoods are like that now. And then we're putting microgrids behind those, because we had 2 weeks without power. We're expecting the public sector to not be able to come through. We had no water that was potable for 7 weeks. So we're building back, saying that, okay, let's not count on government. Let's see what we can do together. So there's a mutual aid aspect to this. And then it's reparations, because these are the folks that suffered, you know. I was told not to talk about the history of urban renewal and redlining on this call, because what we have, because I've been investing in economic justice for a while, but this is a deal that has food security and climate resilience and economic justice, actually, you know, tied to asset creation in these neighborhoods that were harmed by redlining. And I'm finding that foodies love it, right? Because it's food security. And we're also looking at this network of urban gardens, you know, in Southside, in Burton Street, in Shiloh, that could possibly be supplying our farm to table restaurants at much lower footprint to get the food. You know, the food is a mile away as opposed to 15 miles away. And it's making money, you know, in the community garden, but it's small producers, and, you know, you're the arugula, you're the, you know, whatever you are, to do that. And that we're bringing in on this Catacap platform, which is new out of Impact Assets. You can, with a community development corporation as the back end, you can get money out to a group in a garden for as low as $5,000. They can set up a revolving evergreen loan fund. And, you know, most folks can raise $5,000 without Eagle Market Streets, the CDC doing due diligence and underwriting. You have to do $25,000, and so the richer neighborhoods would find that really easy. So we're democratizing the capital going out, and this new breed. So, you know, foundations are colonial tools of oppression, right? And that's just what they are. And the program grants make you change your mission to fit their theory of change. And so you know, they're the landscape architect, and the nonprofits are hired to mow the lawn. And so this money, you know, goes out at $5,000 doing what a foundation PRI would do. And so we have a donor that we've teed up who is, you know, has some money, and she's thinking about her money in this new way, like, give it away, God damn it, this, because I don't need my family's endowment. Like, she's spending her endowment down, but still going to live, you know, in this generation and probably your kids. Is that a deal that would be attractive to some of your folks? That kind of deal? It's climate resilience, food security, and reparations that will pay off with patient capital.
So first of all, amazing. I want to know more about it, so you'll have to send me more, you know, afterwards. I guess
I'm not asking for a commitment, just is that the kind of deal?
Yeah, so I think absolutely. Well, I would say from a sector issue area standpoint, absolutely 100% covered, like climate, reparations, urban renewal, racial justice, social justice, climate, absolutely.
And food security. Yep.
Food security, 100%. So I think, one of the things, while we are a nonprofit and the organizations that we fund are half nonprofits and half for-profits, we don't do philanthropic investing really. So,
Right.
So the businesses that we fund have to show a really solid balance sheet, go through a very rigorous credit and risk analysis, et cetera. So those are some of the things that we look for, along with the mission first, et cetera.
Sure.
And we also have, so that's the investing side. As I said before we hopped on the call, we also have a DAF platform, very, very small and compared to something like an Impact Assets or certainly Fidelity. But we also work with our folks there who are interested in the kinds of things that you're talking about and where we can help direct things through a DAF, not as an investment, but
right.
as a grant. The other piece that we do, and we just did a really interesting, I feel like who Jasmine Crow Houston is with Gooder, Kevin, I'm not sure, but she's if you don't know who Gooder is, everybody should go find it out, but it's GOODR and it's not the sunglass company, but she has an amazing business. And we just did a deal with her, provided a loan to her. And one of the things that's fantastic as a business as she has and as solid as a balance sheet that she has is that all of our loans are senior secured debt. And they're always secured with hard assets. And Gooder's not an asset heavy business. So what we did, we have what we call a catalytic impact pool of about $8 million, which is already committed philanthropic capital in a couple of different categories like agriculture, and when we have a women's capital collaborative. And so what we did in a case like that was we keep that so that part of our, as I said in the very beginning, core part of our goal is to fund folks that wouldn't be able to get access to institutional traditional capital. And we want to do that. We want the folks who are solid risks, have really good credit, but that, wouldn't be able to go down the street to, Morgan Stanley or whatever. And in this case, we took $500,000 from the catalytic impact pool so that we could actually collateralize the loan to Gooder. So that is one thing that we use to really help us be able to finance the folks that we want to, even when there might be some exceptions. So don't know about how this might, Kevin, but would love to learn more.
That's great. Thank you. Yeah, I mean, I think we have the seed money. So I think we could find a way to knit the capital stack together in a way that people would like.
If anybody can knit a capital stack together, it's you, Kevin.
Well, and it's good, Kevin, you mentioned the mutual aid here, and me, I'm also here in Asheville where the hurricane hit, and that was one thing that I saw really pop up that, I think mutual aid comes and goes as the need comes and goes, and the need has been real here for a minute. So we see people just giving what they have, and rather than trying to sell it in a lot of cases, we see people just trying to give and work together. And, it's been interesting to me because I definitely see that, it's nice to have your own stash of, canned goods and clean water and all that kind of stuff. But at the end of the day, no individual or no family was able to sustain themselves off this grid we all live on without each other. And we really, really do need each other to do that. And so to add to what you're talking about, Kevin, I've definitely been thinking about the idea of whether it's philanthropic funds, or I'm not sure what type of fund would be best appropriate, but to be able to do preventative mutual aid in these disaster areas, in these areas where we know that the grid's going to break down. We know the system's going to break down more often than not. And to be able to fund the resources that people need when those things happen in communities ahead of time. If it's not being done by the government, it's not being done by big businesses, then, it's kind of up to us to fill that gap. And so, I would love to see us discuss that sort of idea more in the future for sure. The question that was coming up. Oh, go ahead.
I was just going to say
I
one
had another
thing.
question for you before we go off the topic. Yeah.
I think, one thing that you're both highlighting is sort of you're highlighting by way of the crisis, having highlighted the sort of fallacy or lie of the individual. And I think that to go back to the conversation that we were having about the pricing gatherings, that's part of what we wanted to accomplish with those. Is like, it's not just you. It's not just about your return. You know, I sort of like to say that the stock market is a little bit like a slaughterhouse. Like, you just want your hamburger. You do not want to see what's happening there. And part of what we want to do is be able to sort of demystify and reveal the totality of the I don't know, infrastructure. I'm not sure what the right word is, but it's not just about you. There is, and I think that, you know, in that situation where a farmer's talking to an investor, those are proxies, or can be proxies, for just an awareness that there's other people involved in this as well. The planet's involved. There's somebody else on the other side of this, and they will suffer consequences, suffer or not suffer consequences based on your action. But there will be a consequence, and there always is when there's an action.
Yeah,
It
and
may,
it
it may
definitely.
be delayed. It might be very
Right.
delayed, like Helene, but it's coming.
Yep. Yeah. And you know, one question I had about that, because I like what you're saying there about that communication between both sides and the relationship that's there, because it definitely is. You know, when we do favors for each other, it's all based on relationship. But when that favor gets quantified, commodified, and able to be sold to an independent party who can then change has power over the original partner in that relationship, just kind of goes away. It's not about the relationship to a human being anymore. It's simply about the capital. It's simply about the number on the line there. And so, with the relationships in mind, I'm curious if the fund has any ability to, or if it's moving in the direction of being able to allow non-accredited investors to participate who want to, put their money in their investment dollars to impact our people who, if they want to be able to invest less than they don't have that net worth, and they're just regular folks looking to invest. Have you guys talked at all about the ways that they may be able to participate?
But we don't have any accreditation requirements. I mean, those $1,000
Great.
folks, I doubt, I would guesstimate that, you know, 2/3 of our investors are not accredited investors, and might not even have the ability to be accredited investors. So
That's
that,
fantastic.
you know, that democratization was baked in from the beginning, and is important to us. And we haven't gotten there yet, but we're sort of in the early phases of thinking about what would it look like to further democratize that. You know, sure, $1,000 is accessible to a lot of folks, but what would it look like if it was even less? So absolutely, yeah, we have not done any private offering that would require accredited investors. Not that we wouldn't, but we haven't gone there before.
Yeah, that's great. I want to take some time for any questions that we've got, either from our panelists, Michael Schuman or Kevin Jones, but also if we've got anything from the audience we've got here. While we've got Kathleen with us, I definitely want to take advantage of anything we're curious about or anything we'd like to learn together. All right, well, we'll let things come in through the chat here if anyone has anything. But yeah, Kevin or
Everybody's like,
Michael,
what am I going to get
yeah.
Aunt Julie for Christmas? Is what
Yeah, right.
that's their question. They're like,
Yeah, I
that's
know.
all I can really think about right now is,
Yeah. Where am I going to find a tree? Because
exactly.
they're all combed down here.
Exactly.
The side of the mountain looks like
Where
this.
did I put those
Like a
ornaments?
brush and just comb down the side of the mountain. Yeah.
So somebody says, how do you social your deal flow? So we have a whole lending team, and they are out actively. You know, it's sort of a inflow outflow on the deal flow side of things. We have a lot of folks, because we are well known in the space and in terms of what kind of partners we are, both in terms of our pricing and in terms of our relationality and how we really walk the journey with our borrowers. So a lot comes in, and then we have a lens around racial and social justice, as well as gender justice, and so are really actively looking for organizations that are led by people of color and women. So on that side, so Michael's always going to conferences and talking to folks and just doing the kind of, like, Michael Jones is our VP of lending. So Michael and his team are always out looking and then combing through deals that are coming in.
So one question I have is how perceptions about risk have changed over the long history of the fund. Uh, I assume that you have a low level of defaults, and of course that that means two things. It means that great management on your end, but it also means, are you taking enough risk for the kinds of projects you're trying to do? So maybe just reflect a little bit on your thinking on that and how it's evolved historically.
Yeah, that's a great question. I mean, I think we have a maybe 1% default rate, if that, super, super small. And that is in large part because, well, I'd say it's two main pillars there. One is our credit and risk due diligence is quite extensive. And then we really do walk side by side with folks so that if they are having problems paying their loans because of COVID or something else, that's not the end of our relationship. It's just the beginning of a discussion about how we walk alongside of you until you can make yourself whole enough to start paying again. So, and I think that there always is that question that, and Kevin, I know you have thoughts on this, that if you have such a small rate, then you're not taking enough risk. I guess I would push back on that a little bit in the sense that, we have a risk rating tool that is like, a 1 would be just go talk to Morgan Stanley, and 9 would be you've got some work to do before we can have a conversation. And we like to look at folks in the middle because we want there to be, again, not the folks that could just walk into Morgan Stanley. I think that, one of the things that we have to do is to fund those loans, we have to appeal to investors. And when investors, particularly on the institutional side of things, start to see risk, they're risk averse. And so it's incumbent upon us, if we're able to fund the organizations that we are working with, to be able to present that well to investors. So we try to be smart about, we don't want deals that are rated a 1 or 2, and we have very few 3s as we think about that risk rating tool. But it doesn't necessarily mean like we have to cross our fingers and hope they can pay this back. Not at all. It just means that there are a lot of different variables that have to be considered. So, it's a balance for us for sure. And I completely understand the perspective of like, you should have a higher default rate because that means you're taking the appropriate amount of risk. That's a longer discussion. I don't know that I can honestly speak to how it's shifted over time. I can really only speak to how I think it's largely been the same. I think when we were loaning to Waldorf schools early on, that there was some level of guarantee in that there was a hard asset of a school involved in that. And we try to de-risk things, and we do de-risk things by having it be A, senior, and B, secured. So that is the way, that's a sort of risk mitigant for us that enables us to, to do things that like equity investors might not and might have a higher level of risk because of that. So I don't know if that answers your question at all.
Yes, I think it's really interesting, and I mean, one thing that probably has changed is the environment is now richer. There's a lot more alternative lenders out there, and that's going to keep going up if things go according to our desire out there. So but you do have a flavor to your investment, and I think it's great how you've stayed on mission for 40 years with all of this.
I
Yeah,
guess, oh, go ahead, Kevin. Yep.
well, I'm just thinking back. We did, one of the we did the first social enterprise expansion fund back in 2008. And we were the first to invest successfully in a wholly fair trade company with venture equity in Alter Eco. We were the first one in, and we got Joel Solomon in, who also talked about de-risking. Getting Joel in the deal was a really good thing. But the deal that failed in that fund, we had one failure and three very good successes, was a deal that was where fair trade was only an additional brand element to a juice. It was called Adina, and it was yeah, and we got people in, and they're saying this will really legitimize you because these people have been behind Oregon Chai and Izzy and all these things, and you guys are way off on the mission focus. And it turned out that fair trade is an additive cost, and if you're not linked to the mission, it's an additive cost without brand value. And so we crazily, and this is just a thing that we did, in the second tranche, we said they wanted to dump fair trade, which made sense. And we wrote a side letter saying, we'll publicly say we're not investing in you. Turned out to be a terrible financial decision for us because it wasn't core to them. And so if the mission isn't core to you, then the cost of fair trade doesn't make sense. So, I mean, you invest in folks where there is mission, there is cost. Adina, there was no cost of doing good around it, or there was a cost that had no brand value. And so, being partly mission focused is a recipe for failure. Being mission focused and agreeing you'll have a lower return, but a real return. Yeah, because we had this premise, and we did it with the start of SOCAP, which is this large conference we did, where an impact deal had to have a cost of doing good. If it was a good deal at market rate, it wasn't an impact deal, it was just a good deal. Turns out the market didn't like that definition. They like impact at market rate. And so anyway, I like the fact that you stay with concessionary deals. That's where I feel comfortable. I've done the others, and done that, don't need that.
We're calling them regenerative. I'm calling them, I really would like for the term concessionary to go away.
I know people do, but
and I would like it to become regenerative, because concessionary feels like I'm so sorry. I'm so sorry this rate is so low, rather than let's talk about the financial part of it, but let's talk about the whole circle of impact there.
Yeah. So it's much better branding than we didn't use concessionary. We had this thing called a COGI, cost of doing good. And we had to have a cost of doing good that anyway, nobody liked it. And we also got people to sign a waiver to the prudent man rule so that we could go for impact. Turns out people didn't like that either.
Somebody asked about how can regeneration be measured? That's a great question. I think I'm thinking about a couple of deals that we have where the impact is so deep and so ongoing, in terms of like future generations and things like that. That those are the examples are Lotus Foods and Diaspora Spices. And when I look at, in both cases, they're sourcing their products from outside of this country. And in both cases, they are also tending deeply to particularly with Lotus, to how their product is harvested and the impact on planet for that. The impact for people in terms of the folks who are harvesting their rice, in that example, both on their health and on their wealth, are so significant because of the way they've chosen to pay them, because of the methodologies that they've devised to harvest rice so that it has a better impact on health, and you're not standing around in like dirty fetid water all day long, as well as on the planet in terms of the water usage. The impacts are so layered and so deep. And if you're not familiar with Lotus Foods, you can see some of this outlined on their website. They've got some proprietary technology around this. We have been with Lotus Foods for more than 10 years. And you see them at least in Whole Foods and places like that. You see them everywhere. And we have been their main financing tool for 10 years, 10, 11 years, and I've seen them through some really rough patches. And that is the kind of partnership that they could choose to just do quick and dirty rice and have been profitable a long time ago and make a whole different, have a whole different financial profile in terms of, oh, thanks, Jen, in terms of, what kind of house they have, or all of those things. But they have chosen to have, as is true with Diaspora Spices as well, to have a really deep impact both on the communities with whom they partner, and in terms of the people, and in terms of the places. And when we look at some of those impacts, that is so clear that, and we just had both of them speak. We had a dinner in New York, and they were on a panel about regenerative agriculture and talking about really, without our financing, particularly in Lotus's case, because we've been such long-term partners, they actually wouldn't be here. And now they've expanded into noodles and are taking on $22 million in equity. And the regeneration there is sort of concentric circles of regeneration, both in terms of planet and in terms of people. So that's one way to measure it. I think there's a lot of different ways in terms of also the hows, but that's a very concrete, actually measurable way to look at regeneration.
Yeah, I think it's really interesting because I think it leads into what we were just talking about with Kevin. It's kind of, there's a cost of doing good, but of course there's also a cost of not doing good. And I think the ability to actually kind of quantify that and put that into numbers. My conversation I got to have with Delilah Rothenberg last year about being able to actually quantify those externalities that investors are creating for themselves and for their investors in the long run, sometimes is actually a lot more effective than talking to them about the good they can do, in just kind of the reality of it for a lot of them. So yeah, I guess if you have any final thoughts, if we don't have any other questions, no, hang on, we've got a few more who came up in the.
No, I think those were just links.
Okay. Yeah. So I guess any final thoughts on just those ideas of the cost of doing good and the cost of not doing good?
For me?
Yeah. Yeah.
Oh, I don't think I have any necessarily final thoughts, but I think, for me, the biggest change that we could make to this broken financial system is to demonstrate that there is more than one metric, and that we must create, that sort of holistic circle of return on investment, and make it clear. Back in the day, we talked about SROI, social return on investment. I haven't seen that term in a while, but like that is a metric that is false on its face. And I'm not sure. I'm both hopeful and not hopeful about our ability to change that, but certainly I see, our work as a trim tab, and a demonstration case in the space is doing that, and the work that some of you are doing. And so I think we just have to keep doing it to prove that that there's another way, as Arundhati Roy said, another world is possible, and on a quiet day I can see her coming.
Yep. Beautiful. Well, thank you for your time here with us today. For
Thank
all
you.
of you, yeah, thank you very much. And for all of you tuning in, this is going to be archived on the Main Street Journal. Also be tuning in to Impact Alpha, to Neighborhood Economics, and to the Mindful Marketplace. Thanks to Kevin. Thanks to Kevin Jones, Michael Schumann, to you, Kathleen Paylor, for being here with us. And also thanks to Jen Risley for doing all of the indispensable work behind the scenes. So thanks to all of you. Our next one will be in the new year. Keep an eye out on the Main Street Journal and the other newsletters for our continuing series here. And yeah, everyone take care of each other, take care of yourselves, and have a great holiday season and a good new year.
Thanks, everybody.
Thank
Thank you.
you. Bye-bye.
Bye-bye.